Hello and welcome to another Daily Dose of Insights powered by Container xChange. My name is Christian, and every other day we bring to you the key news, stories, and data points that move container markets and hence your business. Today it's Friday, so we have Fundamentals Friday here at Container xChange. We typically take a look at one key open question that remains sort of unanswered in the market, and provide some thought, some intelligence, some data behind this. Sort of like food for thought for the weekend. Let me quickly share my screen to tell you a little bit more of what I'm talking about. There you go. So today I'd like to further consider the key question whether demand will hold up throughout Q3 or whether we have seen the peak of the market. And this is very, very relevant. We've talked about this over the past couple of weeks. We have the prevailing opinion in the market is that the demand rush and hence the elevated rates have been a result of retailers and other importers pulling orders forward from the traditional peak season, which is sort of in the latter half of Q3, typically to be ready for the holiday sort of season. And coupled with capacity restrictions due to the diversions around the Cape of Good Hope and port congestions, etc., this has pushed up rates significantly. And now, whether demand will hold up throughout the remainder of Q3 will determine whether rates will hold up throughout the remainder of Q3. And here I thought this was very, very interesting to share some data from xChange. I'm also going to post the link to the article that I read in the comments. They've examined essentially blanked sailings or planned blank sailings by the carriers for the coming 10 weeks, so the remainder of Q3. And what we see is that carriers are relatively bullish here. So they are planning to only blank 3.9% of all sailings on the Asia to North America West Coast trade lane, and only 5.9% on the Asia to Northern Europe trade lane. And this is very much in line with pre-pandemic averages. And at the same time, deployed capacity, so actually sort of TU tonnage on those trades, is 2024 is around about 25% higher than 23, so last year, and still 10.2% versus 2022, which sort of saw peak capacity deployment during the height of the COVID pandemic, sort of in Q3 back then. So what you see is that carriers do expect demand to hold up. That's why they do continue to deploy that capacity and are not planning to blank out any of those sailings. Of course, it will now remain very, very interesting whether that demand really materializes. Latest GDP figures from the US have sort of confirmed this. There's very strong sort of GDP growth, and price pressures remain in check. And we expect interest rate reduction in September at the Fed meeting. All of that points towards a continued demand, healthy demand situation. But of course, if that does not materialize, then we will see a significant drop in rates and corresponding container prices. Now, that's it from us for today. Thanks a lot for tuning in. Have a fantastic start into the weekend, and see you all on Monday. Take care.